Let's take a look at the details behind what we do. We are trying to build the best investment process we can, one that balances and quantifies both risk and return. If you are not quantifying risk, you are likely taking too much of it. We do this not by guessing, we do this by studying Nobel Prize-winning theories, hundreds of historical data series covering thousands of years, and math. We are marrying theory and facts. Here we show a risk and return chart from 1970 to 2016, with average annual returns going up and down, and risk going across horizontally. We show 7 asset classes roughly covering the entire world, from U.S. stocks and bonds to international stocks and bonds to gold, real estate, and commodities. Now what jumps out to us is this blank white space in the top left. This is the high return, low risk space, and the world doesn't tend to give us many high return, low risk investments. Now when looking at this chart, what most investors will do is they'll start with the exact opposite end, the low return, high risk space, and they will cross these out. Most investors don't have a lot in gold or commodities. Then investors will shift their sights to this space, real estate and international stocks. While they might be interesting, over the last 47 years, U.S. stocks have had lower risk and higher return, so most investors don't own much in these two asset classes. Then investors will look at international bonds, and while it might seem interesting, it also seems to be on a line between U.S. bonds and U.S. stocks, so most investors don't own much international bonds. Most investors are wrestling with, do I want more in low-risk, low-return U.S. bonds, or more in high-risk, high-return U.S. stocks? But let's step back for a minute, and let's just look at U.S. stocks versus gold for this 47-year period. Now the question is, if in 1970 you put half your money in U.S. stocks and half in gold, how would it have done from 1970 to 2016? Well, most investors think if you put half your money right here and half your money right here, you'll be right in the middle. But what actually happened over this period is that U.S. stocks and gold had low to negative correlation. When one was going up, the other was often going down, and vice versa. And what actually would have happened to your money is you would have been right here. If you put half your money in U.S. stocks and half in this seemingly horrible, high-risk, low-return investment, you would have actually had a portfolio with lower risk and slightly higher returns than U.S. stocks. That's what diversification does. It should reduce risk, not return. Going back to this chart, how can you be in the top left? If you stopped crossing things out, if you embraced global diversification and owned everything, you would have been right here. Harry Markowitz looked at this situation, and this line that I'm drawing here, he drew this. And he called it the efficient frontier. And he called the portfolio with the highest Sharpe ratio the Tangency Portfolio. That's why we call our portfolio the Supernova Asset Strategies Tangency Portfolio. We're trying to replicate in practice what Harry Markowitz created in theory. Our Tangency Portfolio is our interpretation of the Tangency Portfolio in modern portfolio theory. We aim to provide global beta and the largest Sharpe ratio available to investors. Our focus on beta results in a rigorous data-driven investment process. We are world neutral when allocating our assets and creating position sizes. The factors that lead to our position sizes include global GDP, global equity market capitalization, global debt outstanding, valuation, and correlation. We are process-oriented and lean on data at hand rather than trying to predict the future. The output is a strict focus on risk mitigation. On a risk and return chart, the goal of our portfolio is top left, low risk and high returns. This chart shows about 60 different asset classes, from Brazilian stocks to Japanese bonds to copper to Finland stocks. What we're trying to do is be globally diversified and get towards the top left. Here are the numbers behind the graph we saw previously. That diversified portfolio would have had the second highest average annual returns and the second lowest risk. That leads to the largest Sharpe ratio. Let's just look at average annual returns for a minute, stripping away that diversified portfolio. The average of these 7 asset classes was 8.56%. So how would that diversified portfolio have returned 9.95%? Well, 2 men, one by the name of David Booth, his name is on the Chicago Business School, and another named Eugene Fama, he won a Nobel Prize, they looked into this, and they called it diversification return. It is the extra return you get due to combining low and negatively correlated assets and rebalancing. This chart shows the 6 worst calendar years from 1970 to 2016, and this is how we read it. If we start with U.S. stocks on the left, U.S. stocks are a perfectly fine asset class, but of course they've had many down years, so many that we can't even fit them on this chart. U.S. bonds, this is the 10-year U.S. government bond, another fine asset class, but of course many down years. International stocks and bonds, many down years. Real estate, gold, and commodities, many down years. That diversified portfolio would have had only 5 losing years since 1970. Only one of those years was worse than 8% in a calendar year. Diversification is very robust. Now we showed you a 47-year chart, but we don't think that the next 47 years will look like the past 47 years. So let's look at rolling 10-year data points. What does that mean? If we start in 1970, the first 10-year period is 1970 to 1979. The second 10-year period is 1971 to 1980. Then we go to 1972 to 81, etc., etc. When we look at U.S. stocks, the long-term average was about 10% return with about a 15% risk, and this is what we think most investors think they're getting. When they invest in U.S. stocks, they think they're getting this, but over a 10-year period, their returns were all over the place. There are 38 different decades here, and it was tough to tell if you were going to get an outstanding decade averaging about 19% per year, or a horrible decade averaging about 0. Now we'll introduce another portfolio. This is what we consider the typical Wall Street portfolio, 70% U.S. stocks, 30% U.S. bonds. It had a similar long-term average to U.S. stocks with less risk, but still the returns are all over the board, from 16% to about 2%. You still don't know what your returns are likely to be. Now we show the 47-year average for that diversified portfolio that we saw earlier, averaging about 10% with a 9% risk. And here are all the decades around it. You had much more confidence in what you were going to get. There weren't a lot of surprises. What's interesting is that all 3 investment philosophies had similar expected returns, but different risk profiles. If we're going for the top left, the choice is pretty easy. We can then blow this chart up, and we believe that this is a choice that investors get to make. Do they want to be U.S. stock investors? Do they want to be 70-30 investors? Or do they want to embrace global diversification? We looked at 10-year data. Here's 5-year data points. Again, a similar story. What we'd like to look at is this. This is the 46-year average of U.S. stocks. And over 5-year periods, while investors might think they're going to get the purple dot, the long-term average, they in fact get a very, very wide range of outcomes. Over a 5-year period, very, very difficult to know what to expect when investing in U.S. stocks. But further, we like to show this point right here. This is a 5-year period investing in U.S. stocks where you got a 0% return with an almost 18% risk. Now, everybody knows what a 0% return is. If you put in $100, 5 years later, you have $100. But what does high risk really look like? This is the period 1973 to 1977, and this is what it looked like. That roughly 0% return was not really the average. It was essentially the best case scenario. What investors were faced with was a swift 43% loss. We would argue that many investors got large losses over this period and did not receive the roughly 0% average. Here's another 5-year period where U.S. investors got a 0% return over that time period. This was 2007 to 2011. How did you do during this period? It's unlikely that you had a 0% return. Further, we think about valuation and we factor this into our process. We focus on 2 valuation metrics on the equity side of the portfolio. The first is Shiller PE. Robert Shiller won a Nobel Prize for this. The second is market cap to GDP. Warren Buffett has said he favors this method. While this data is not necessarily current, based on when we printed this chart in October of 2016, based on the Shiller PE of the S&P 500, we should expect around 2% average annual returns over the next 7 years. If we use market cap to GDP methodology, we should expect around 1% per year for the next 7 years. Now, these charts do not predict the future, they merely give an indication of the odds, and these are smoothed averages. Looking at the periods where the Shiller PE was over 25, in 68% of the periods, we had returns under 3% annually over the next 7 years. Now let's look at Russia. Many people instinctively will shy away from a place like Russia. But we believe that the question is, if you believe Russian stocks will behave differently than U.S. stocks, the question is not, should I own Russian stocks? The question is, what is the prudent size of Russian stocks in my portfolio? Diversification is all about low correlation. Based on valuation, we might want a larger than normal weighting in Russian stocks. Using the Shiller PE suggests returns of around 12% annually going forward. Using market cap to GDP suggests around 25% going forward. In the periods where the Shiller PE was under 16, 67% of the periods showed returns over 10% annually over the next 5 years for the Russian stock market. Here's what our Tangency portfolio looks like on the equity side of things. Note that this is subject to change, but none of this is a guess. It is all based on the math around our process. Here's the debt exposure. Here's our disclaimer and confidentiality, and our asset class references and disclosures. Feel free to reach out to us to discuss this in more detail.